And then I'm going to give you, which inventory account are we talking about, do you think here, Mr. Waller? Which inventory account? Because we know about 3, don't we?
Right.
There's 3 across the top.
Yes.
What are they?
Beginning inventory, work in process, and finished goods.
Beginning inventory?
What? Direct material.
direct materials, work in process, and finished goods. So Alex, which one of those are we talking about here? Because that's,
Finished goods.
finished goods we are talking about here, okay? Okay, because that's the only T account that has both production information and sales information in it. Production information is the in to finished goods, units produced. Units sold is the out. So that's the only T account with information from both. And then I'm going to give you a formula here. Change in inventory times fixed overhead per unit equals the difference in operating income. Okay. So the change in inventory, specifically finished goods inventory, times fixed overhead per unit equals the difference in the operating income. And this formula really only works, and you might make a note of this, really only works when production is constant. Okay, when production is constant, this formula works and makes life very easy. Catherine, can you read my handwriting?
Yeah. Just trying to comprehend what you mean by difference in operating income.
Difference. The difference between variable and absorption. That was very easy, wasn't it? Now, who here would like to be successful in their careers? Erica doesn't want to be. Okay, and so successful people, if you're successful in a professional career, very often you wind up with more and more responsibility, right? And so imagine yourself very successful. You are the manager of a division of a major U.S. company. You know, Walmart, actually, Walmart considers their one store the equivalent of a division. It's like several hundred, I used to know the number. It's like $200 to $300 million in revenue is average for one Walmart store. That's a lot. Yes. Is average. It's a lot, big numbers. Walmart has big numbers on their financial statements. So imagine you are a division president or division manager, and you are evaluated based on your profitability measured using the absorption costing income statement format. And you've got a budget target for profitability for the year. Okay? Brandon's not getting very excited about this yet, but I'm trying. And so imagine you've got $1 million bonus riding on if you meet or exceed your budgeted profit target for profit using an absorption costing income statement format, you will receive $1 million. Okay, and it's not unrealistic. That's not an unrealistic number for people at this level in large organizations. And so, you know, that would buy a pretty nice house in Warrensburg. Or maybe even, you know, maybe even kind of a block of houses in Warrensburg. And so, so would that get your attention? I mean, as a manager, if you knew that there's potentially $1 million residing on your, contingent upon your performance as a manager, would that get your attention?
Hike up productivity is what I would do.
I'm sorry?
I'd hike up productivity.
Would you? You'd hike up productivity. Why would you do that?
Well, if you produce more, your absorption statements can be higher.
You'd do that.
You give $1 million.
Well, if you want to get there, if you are told by your accountant, you come back from Thanksgiving, your accountant says, you know, you're going to be close, but I don't think you're going to make it. What can you do?
Make a whole lot. Sell more of your major profit.
I mean, if you're going to be now we are on camera, but I do say this even when I'm not on camera. You know, am I suggesting you do some of the things we're about to talk about? No. okay? I'm not suggesting that you do this. But what is the most simple calculation of profit? Revenue minus expenses, okay? So you've got to do one of two things, don't you? Raise revenue or lower costs. How would you go about, if you wanted to be a little bit more sneaky about it, how can you go about increasing revenues? Recognize revenue early. Exactly right. Exactly right. And can that be done? Absolutely. In a lot of, because the example is, I mean, in your textbooks, in your problems, it's always really easy and straightforward, right? They tell you when. But suppose you've got this. If you are in the business of making these advanced computer-directed machines that do computer-guided work, okay, in building things, gadgets, aluminum, maybe carving out aluminum, CAD/CAM, carving out aluminum. When have you actually successfully made a sale? When you take an order? When you have shipped the item? When the customer has physically received the item? Or when the customer has actually received, unpacked, and successfully operated said item? When should revenue be recognized? And see, that's for other classes. I'm not the expert in that, but I just say that, give that by way of example to kind of stretch it backwards along the line a little bit. Doesn't seem too far-fetched in that environment. To recognize, well, maybe instead of recognizing it when it's installed, we'll just recognize it when they receive it. And then poof, what have you done? Increased revenue. Okay? Can you also do the same for expenses? Yes, kind of, except for with expenses. When do you want to recognize them this year? You want to hurry up and recognize more expenses this year? No, you want to do what? Defer them. Now, if you're working at a large publicly traded company, who might catch these particular transactions? Auditors. And has anybody had auditing? Nobody yet. Boy, is that going to be fun when you get there. Huh? Yeah, it's going to be fun when you get there, too. The auditing instructor at my old institution described it as like trying to learn how to snow ski without ever standing on skis or going outside or getting on a mountain. And I should probably say without getting on a mountain or even going outside or even standing on skis, but you're going to learn how to ski. So that's kind of what anyway. So that'll be fun for you. I'm glad I get to teach what I teach rather than auditing. But anyway, auditors spend a lot of time checking beginning and end of year activities. Why? To precisely make sure that things are not slipping across the border from one year to the next. Okay? So, but there's always brand and strategy, which would suggest is a kind of a little more sneaky one. All you have to do to increase profitability is to increase production. Because what happens is the more units you make and don't sell, where do those fixed overhead costs go? To inventory, which is on the balance sheet. Where does over and under applied overhead go? Where does over or under applied overhead go? Cost of goods sold to the income statement. So those are the two choices, right? You can either make it, attach that fixed overhead to a unit that's now in inventory, or not make it and let it wind up in cost of goods sold and go to income. And so that's how it works conceptually.